If you've been looking for a way to passively invest in real estate, more than likely you've come across the term syndication. So, what is a syndication? What does that mean? Who are the players involved? And more importantly, how do I make money? These are just a few of the topics that we're going to be covering in this video. If you're new here, hi, I'm Dr. Jeff Anzalone, a periodontist on a mission to spread the word about how building passive income streams can allow you to exit the workplace early. Download the free passive income guide with the link below this video. I recently spoke to a group of periodontists in Dallas about real estate investing. Most didn't have any prior real estate investing experience, and they were just comfortable with following their financial advisor's advice of 401k investing until they were 70 or 75. Now, I occasionally visit investing forums, online, Facebook groups for doctors, etc. And when I get on these, most of them are discussing what are the different types of mutual funds to buy, stocks to buy, should you hire an advisor, the latest cryptocurrency fad, or what percentage of stocks and bonds is best for my portfolio. It's just amazing that most of these people have been practicing for like 15, 20 years or more and never mention real estate investing. Look, I used to read all the financial magazines like Money Magazine, Kiplinger's Personal Finance, all those. And do you know what the common thread these magazines are pitching? That's right, Wall Street investing. Now, for years, I was focused on which index funds had the lowest fees, which ones had the longest track records with the best returns. I was just so obsessed with that. Then, after I began investing in real estate, I started to notice that the 9 to 10 figure net worth people had made all their money with real estate, not in their 401k. Interesting, right? Now, I have no issue, getting some type of investment advice. Just don't give me only one option to choose from. To me, that's unethical. And what I've noticed going through a lot of these things is there's really two main ways typically it's taught to build wealth. And that is the stock market, which is your traditional retirement accounts, 401ks, IRAs, etc. These are for those that are wanting to build wealth slowly with a little to no thinking involved. They're only focused on an annual return, yet risky somehow, sometimes due to volatility, like the stock market. Second way is real estate. And this allows you to build wealth as quickly as you want. And you could use OPM or other people's money. It gives you unbelievable tax advantages. And again, it provides you options to early retirement. So now it's up to you to choose. Now, I started off the first 12 years of practice following only method number one because I didn't know anything about method number two. I'm now on a mission revealing what I'm personally experiencing from investing in real estate, cash flow to replace active income, tax benefits, etc. So I want you to have options when it comes to retiring. So let's get started. Let's first start off on talking about what exactly is an apartment syndication. Now, an apartment or real estate syndication, it basically involves the pooling of money from several investors in order to purchase a physical property that's much more expensive than any of them could have afforded on their own. Now, typically, these types of investments are governed by the SEC or Security and Exchange Commission, and you must file certain documentation, such as a PPM or the Private Placement Memorandum. All right. Next, who can invest? Well, originally syndication deals were exclusive only to the ultra wealthy, but now they're much more accessible to you and me. This is mainly due to the emergence of real estate crowdfunding since the Jobs Act was passed in 2012. Most syndications are typically reserved for the accredited investor. And according to the SEC, accredited investors, anybody with an annual income single 200 making at least $200,000 a year or more in each of the two most recent years, or married couple making $300,000 a year. And a person also, you could also be an accredited investor if you have a net worth of at least $1 million, which does not include your primary residence. All right, so that's who can invest. Now let's talk about who's involved. There's there's several groups involved. The first, the kind of the main one, is the general partner also known as a GP, also known as a syndicator. And this person, basically the general partner, is an owner of a partnership. They have unlimited liability that's active in the day-to-day operations of a business. Their job is to select target market for investing. They perform inspections. They handle the due diligence process. They run the numbers. They take the asset. They place it under contract. They source capital from passive investors. They obtain the loan. They keep it occupied, and they help manage the property. Second main group is you and me, the passive investor or limited partner. They're also known as LPs. They're responsible for actually helping fund a portion of the initial equity investment, and they have zero control, which is really nice, zero control over any aspect of the business plan. Examples include a doctor working full time, not wanting to deal with tenants, remaining completely hands off. Pretty good stuff. Now, some of the other parties involved are property management company. And many times the GPs will hire these people, and as you can imagine, their main responsibilities are they manage the day-to-day operations uh, on the building, and they also help to execute the general partner's business plan. Potential additional services that really good companies provide, or they can advise on whether it's an attractive neighborhood or maybe a struggling neighborhood within a market. Maybe stay away from this neighborhood, or hey, you need to go over here because they have an Amazon distribution center or something like that that may be coming in. So they can help point them in the right direction, but yet steer them from the wrong direction. They can also offer locations of prospective properties based on the particular general partner's business model. And they provide a pro forma, which is basically projected financials on prospective properties based on how that company would manage them. Fourth person involved is a commercial real estate broker. Now, syndicators having great relationships with brokers, they're typically able, these are the ones that are able to find the absolute best deals out there. Now, most general partners, they work with multiple different brokers, and they obtain access to either on market deals, but the really good ones have access to off market deals. Brokers will put together the OM, or offering memorandum, which is nothing more than the marketing package of the property to the general partners. Now, for on market deals, the broker typically manages the offer process, and they ensure that the deal arrives at the closing table once it's awarded to an investor. Fifth person involved is a real estate and a securities attorney. And they're basically responsible for developing and reviewing four major contracts: the PSA, or purchase sale agreement, the operating agreement, the PPM, or the private placement memorandum, and the subscription agreement. So let's start off with briefly the PSA first, the purchase and sale agreement. Basically, this is just a legally binding document between the buyer and the seller of a property that establishes the terms and conditions to a real estate transaction. So in a PSA, it basically states what requirements the buyer must meet, along with the purchase price, any limitations, and any contingencies. If you've purchased a home before, you probably are aware of the PSA. These are usually created by the real estate attorney that's actually representing the seller, but the buyer's party, the buying party, should also have their own real estate attorney review before signing. Very important, especially if you're buying a home as well. Second is the operating agreement. Now, in an apartment syndication, there's typically two types of operating agreements. The first one is the operating agreement between the members of the GP, the members of the general partner. So if the general partner group is made up of more than one member, it basically would outline the responsibilities and the ownership percentages of each one. And then there's also going to be an operating agreement between the general partners and you, the limited partners, the passive investors. And this is going to outline the responsibilities and the ownership percentages between the GP and the LP. The third type of agreement is the PPM, or the private placement memorandum. Now, this is nothing more than a legal document that lays out the details and the disclosures of an apartment syndication. It discloses all of the important information an investor may want to know before they commit to agreeing to the terms of how everything goes. So, and just remember, with any type of deal, there's never a guarantee. I get this question asked all the time. Are these deals guaranteed? Can they go south? Absolutely. And this is where in the private placement memorandum, this is where they're going to spell out everything that's out there in your investment. So make sure that you read through that very good. Now, when investors are reviewing an investment opportunity, the contents of the PPM should include, again, everything that's needed for you to make an informed decision, but not limited to the summary of the offering, minimum, maximum investment amounts, description of the asset, any of the key risk involved, disclosure on how the GP and LP are paid. All this should be included in there. And it should be prepared by a securities attorney for each particular apartment deal. And then the last type of agreement is a subscription agreement. And this is an investor's application to actually join the limited partnership, and it's prepared by the real estate attorney. It's also a two-way guarantee between a company and a new shareholder, which is you, the limited partner. The company, typically an LLC, will own this apartment syndication. It'll own the apartment. So the company agrees to sell a certain number of shares at a specific price to the limited partners, and in return, the limited partner promises to buy these shares at that predetermined price. Again, that's a subscription agreement. So, what are the main types of apartment syndications out there? So, more than likely, the syndicator is either selling private securities to limited partners under either Rule 506B or 506C. Now, 506B, we'll start off with that first. Um, General solicitation or advertising of these securities is prohibited. So basically, they can't advertise. They're able to sell to an unlimited number of accredited investors and up to typically 35 non-accredited but sophisticated investors. These are people that have some sort of business knowledge and that sort of thing. The issuer may rely on investor just self-certification. So typically, if you're filling out your paperwork, it'll ask you, are you an accredited investor? And then you just check off the box, whichever one you meet the criteria. So basically, you're just self-certifying in a 506B. And also, this is important, the issuer, they must have a pre-existing relationship with their potential investors, all right? Which is different than a 506C. And under this rule, those selling securities, they can basically just advertise on Instagram. That's why you see them on Instagram, Facebook. You can see them on a billboard out there. So they can advertise their deal on their website, anywhere. Now, these are typically to accredited investors only, and they actually must be able to demonstrate that they took, quote, reasonable steps to ensure the accredited investor status of all their investors at the time of the investment. So, in other words, the issuer must verify that the investors are accredited. And to do so, a third party is typically involved, like a CPA, an attorney, registered deal broker. They can all review the investor's financials, look at maybe their W-2s, tax returns, brokerage statements, etc. You can also go to different websites. Probably one of the most popular one is verifyinvestor.com to have this done. And once you do this, then you'll be set to investing in any type of deal that you want to. Now, let's get into how do the general partners make their money? Well, there's a couple different ways. The first one being the acquisition fee. Now, this is an upfront fee that the sponsor is going to charge on the purchase of a property at closing. Now, these usually range from anywhere from 1% to 5% of the purchase price, depending on the size, the scope, and the experience of the GP and the profit potential. Now, this fee, basically what it does, it represents the work that it took, it's the acquisition to acquire the deal and put it all together. Now, it's typically earned at the close of escrow on the acquisition. The second is the asset management fee. Now, this is an ongoing fee that compensates the sponsor for their management of the property during the investment. So their duties include maybe like goal setting, meeting deadlines, communication, facilitation between the investors, and then again, taking care of the day-to-day operation issues. Typically, this fee is anywhere in the range of 2 to 3% of the gross revenue collected from the property, and it's usually paid out quarterly. Third way they get paid is a profit split. Now, whether you're a passive investor or a general partner in a syndication, you can expect to be compensated whenever the property is sold. There's all types of different splits out there. I just wrote a couple up here: 50-50, 80-20, 70-30, 90-10, 85-15. So if the syndication is basically structured where the limited partners are offered a preferred return, then the remaining cash flow after the preferred return is distributed is split between the limited partner and the general partner. This is basically the equivalent of interest on their invested capital plus the majority of the profits. Now, once the limited partners receive the remainder of their equity investment after the property sells, then the general partners receive a catch-up distribution. Again, it goes back to the profit split. Now, after this takes place, any remaining profits are split between the limited partner and the general partner. Fourth is the guarantee fee. Now, after the closing, the loan guarantor, he actually signs on and guarantees the loan. He or she is actually paid a one-time fee called the guarantee fee. The loan guarantor could be either partners in the GP, or they could be a third-party person. Now, if it's a third party, they would have to meet the liquidity, the net worth, and or experience requirements needed to qualify for financing. The GP typically offers them, anywhere from 10, could even be up to 30% of the general partnership shares, in addition to that, or it could be like a one-time fee as well. Now, if members of the general partner are the loan guarantor, they'll typically charge roughly 2 to 3% of the loan amount, but again, that could vary depending on the size of the loan. The fifth way is actually the refinance fee. Now, if a refinance does occur during your project, a refinancing fee is paid to the GP as compensation for the actual work required to refinance the property. In most cases, this fee would be roughly around 0.5% of the new loan amount that's obtained. So that's how the general partners make their money. But how do you, the limited partner, make money? How do you get paid? So there's typically three ways that this could happen. The first is a preferred return. And a preferred return basically just refers to the order in which the profits from a syndication are distributed to you, the limited partner. Now, it's a threshold return that limited partners are offered prior to the general partners receiving payment. Many of the deals that I'm currently in, they pay out typically about a 6% preferred return on a quarterly basis. This means that the investors, the limited partners, are going to receive their first portion of the cash flow up to 6%. So if the project cash flows 6%, then the limited partners receive the 6% preferred return, and the general partner does not receive a profit split. Now, if it cash flows less than the 6%, the limited partner receives a return of less than 6%. If the project cash flows more than 6%, then the limited partner, you're going to receive your 6% preferred return, and then any of the remaining profits over that are split between the general partner and the limited partner. Typically, the preferred return is considered a return on capital, meaning the distributions that you would get does not reduce the limited partner's capital account. Second way, we talked about this up there, the general partner, was the profit split. So again, if a preferred return is offered, the remaining profits are split between you, the limited partner, and the general partner. Again, I've personally invested in deals that have a 70-30, 80-20, and an 85-15 split. So basically the 70-30 would be 70% goes to the limited partner, 30% goes to the general partner. So the limited partners receive distributions from the profit split basically on an ongoing basis during the business plan. So again, if the cash flow exceeds the preferred return and or the sale of the apartment building. And then the third way is refinance or supplemental loan proceeds. So if the syndication ends up refinancing into a new loan and or secures a supplemental loan, the passive investors will typically receive a distribution that is a portion of their initial equity investment. The proceeds from a refinance or supplemental loan are typically, again, are considered a return of capital, which is like the profit split. This means that the proceeds reduce the limited partner's capital account. Now, I understand that there's a lot to learn when it comes to passively investing in real estate. And if you want to figure out, you got a deal and you're looking at it and you want to figure out if it's good or not, then head over to this video while I will help you out for sure. See you over here.